Dipen said, good morning, thank you for joining us. We have to start with Yes Bank. What is going on? What is going on? Reserve Bank of India gives them a clean sheet. When they came out with the numbers, not for the quarter gone by, but when they came out with the numbers for Q3, they said, look, all is well. We've taken all the problems. There are no skeletons in the cupboard, but looks like right now, I mean, the cupboard only has skeletons and skeletons and skeletons.
Yeah, so first we have to look around and find the cupboard. Pardon me for being skeptical here, but it's been a while since we at HDFC Securities have desisted from having coverage on this stock because we really couldn't put a finger on the story and join the dots. And that has been our persistent informal feedback that we've been collecting from market participants over a period of time as well. And this latest, I hate calling it a blow up, but there's no other word to describe it, only confirms our worst fears that something was seriously amiss. And while I do have some faith that the new management under the leadership of Mr. Gill will figure out a way forward, and I think the struggle is uphill for them here on. I don't think it's a full-fledged blow-up of a bank as yet. I do feel they are in dire straits, and some serious repair work will have to happen here on. If management rises to the occasion, and this is what makes the story very interesting for investors at this point of time, if management rises to the occasion, and may the force be with them, then we could actually see a great new bank being created in this country all over again, if not from scratch, then halfway to scratch. I am hopeful that this happens. I want it to happen, but frankly, to assess the probability that this can happen and to assess what is going to happen in the next 6 or 12 months at Yes Bank is anybody's guess right now. I think the first step to solving a problem is to recognize that there is one. And I had this similar view when we went through, the recognition cycle, the stress recognition cycle at across the Indian banking space 2 or 3 years ago. I'm constructive that all the bad news is now coming out. I'm happy that we are tackling it head on, and I'm happy that we are not kicking the can down the road. So let me tell you, for investors, this could be a great opportunity. It's very difficult times for the management and shareholders of Yes Bank, but I think hopefully it should now lead on to some peace and some value creation in a sustainable manner.
Right. Dipen, aside of Yes Bank, of course, there's lots in the market as well. Autos are fairly beaten down. There was that comment by R.C. Bhargav on the sidelines of Maruti's earnings, performance, saying that they're going to phase out diesel cars by 2020. The commentary from Hero MotoCorp as well has been fairly lukewarm itself. Where within autos do you see opportunities, or would you say up until the BS6 norms adjustment, one would be a little wary of autos?
Yeah, so let me preface my comments on the auto industry by saying that for some time now, we as investors and stock market participants had become painfully, unaware or were in denial of the fact that at the end of the day, autos or automobiles is a cyclical industry. And we rode the cycle for 2-3 years, assuming that, this was something like FMCG and we could get it to grow in linear progression for the rest of our lives. Some of that is unraveling, obviously. The second thing is that we have run into serious demand constraints on the autos. So if you look at four-wheelers, then the demand from the cab aggregators has come off. Consumer sentiment has taken a beating. Urban incomes haven't kept pace with the aspirations of citizens. Obviously, there is rural stress, deep rural stress, which affects both Maruti and Hero because half the demand for their vehicles comes from upcountry areas. And it's beginning to reflect even on a core segment like motorcycles as opposed to cars, which are much more discretionary in nature. And Hero has suffered that, that volume crack in the last quarter, I think 11%. So I think somewhere this is now leading on to some sensible bottom being formed, because keep in mind one thing, that both of these guys are market leaders in their respective segments. So Hero for two-wheelers and Maruti for four-wheelers in this country. I don't see that changing meaningfully despite the aggression of new players for Maruti or some of the existing ones as well, or whether it's from Bajaj or TVS or HMSI for Hero. I don't see that leadership position going away anywhere. Both of them have got very exciting pipelines of products to launch over the next few years. Maruti is also going to go through the transition of phasing out diesel vehicles. And maybe that's not such a bad thing, because I think now with CNG stations coming up in more cities of the country, the price differential between CNG and petrol, the operating cost differences will make CNG cars attractive as well. I drive a CNG car myself. So I can tell you that phasing out diesel is not such a bad thing. Of course, it will lead to some impact on rural demand. I think both these stocks have corrected from peak. Maruti with, of course, more dramatically. Hero at 3.3% dividend yield, 14-15x kind of multiples. Maruti also getting into the value zone. I think in a quarter or two, we should see bottoms being formed here. Long-term investors should possibly not try and exit at this point of time. They probably missed out the tops, and you should just hold on for safety right now.
I just want to talk about the market positioning. Global markets at an all-time high, Indian markets at an all-time high. When we started the year, everyone, at least globally, was of the view that nothing could go right. Then few turned optimistic. Now everyone is optimistic. So my only fear is that if globally things slip, what happens to us? We have an election and risk of global reversal.
I would agree with you there, and I've said this earlier, that there doesn't seem to be too much of margin of safety right now in the markets, but that's how stock markets are. They tend to, so the pendulum of sentiment swings, and swings without warning, and it can swing both ways, let me add. I think right now election noise is driving out all other signals. There are some other signals which are equally, if not more important, but you have to keep that, you have to look at markets right now from the perspective that FPIs have pumped in close to about $10 billion over the last 3 months, even as Indian inflows have kind of dried up. Relatively speaking. The near-term macros actually look challenging, if you ask me. There's a hot summer in progress. There is some bit of monsoon risk which we don't have a finger on, which is the way it is every year. There is weak consumer data. The high-frequency signals are all pretty weak right now. Global growth in a slowdown, at least for now, and that's something you've pointed out. Oil prices have risen sharply, although if you look at the immediate term, 1 or 2 day old news, it looks a little exciting. But by and large, the consensus was that oil prices should stay $60-65 to a barrel, and that looks a little challenged right now. The INR has finally begun to weaken all over again in response to these changes. And of course, there will be fiscal challenges for the new government, and we will have pretty much lost out on pre-monsoon buying in a whole lot of consumer categories because of the election turbulence. So I do believe that there is I would say inadequate margin of safety, especially if you look at earnings which don't look exciting right now. Of course, there are stock specific stories. Yes, I agree with you. Things don't look too exciting from a broader market perspective, but do please look for stock specific stories. And I think that's the point of tracking earnings season very closely. 1 or 2 out of 10 results that will come out will tell you something about a sustainable alpha trade playing out in several stocks, and that's what investors should do right now. Remain very, very stock specific. Don't go out and buy the market.
Sure. Then, everyone's been talking about the consumption story. We've already discussed auto this morning, but then, when we're talking about consumption, what would you really be looking at, in terms of stocks or possibilities, opportunities, whether it be from a valuation perspective or whether it be from an earnings potential point of view? What would be on your radar if you were to play that theme?
So frankly, consumer stocks always look overvalued. If you look at the FMCG pack, their multiples range anywhere from 35 to 55x. And the value hunters among us assiduously avoid those stocks in our portfolios. And I know of several senior fund managers who find these valuations unattractive in the FMCG pack. That said, there are cheaper stories with much more sustainable earnings growth, and many of them are interestingly poised. So I'm sounding like a broken record when I mention ITC here, for example. which is available at, well, it'll always be available at some discount to the broader FMCG pack, but the discounts versus that pack today for ITC, especially in view of other factors, if you consider that they've been taking price hikes and should now be seeing volume growth after an interval of about 5 or 6 years. So that stacks up ITC very well in anybody's portfolio. That is one bit. Now on the consumer discretionary side and the appliances side, we have a long-term secular story playing out all over again. The pessimists would argue that much of those stories are actually reflected in the high valuations that stocks like Symphony or Voltas, for example, both of them leaders in their respective cooling appliance categories like air coolers and air conditioners, would be trading at. Having said that, we are going through a very, very hot summer right now. There could be tactical trading opportunities here. Yes, I admit the multiples don't look too exciting, but you know what, if you take a 2 or 3 or 5 year view out, a forward-looking view, and which is what I think much of the $10 billion of FII money or FPI money that has come in the last 3 months should be doing, then I think they should be going out and buying stocks like these. So you have to be, and let me repeat this, you have to be picky and choosy in spotting consumer stories. An interesting take on consumption that I have in India is that rather than play direct consumption stories, you can look at retail financiers, for example. And if you look at some of the personal loan and credit card portfolios of select banks, then you will notice that there are indirect opportunities to play the consumption stories there as well.
Thanks so much for joining us this morning, Dipen. Good to get your perspective on things as they stand.